You're listening to the Maple Tree Capital podcast, where we put retail first, institutions second. Please note that all opinions shared today are that only of Maple Tree Capital and no other party. Please do proper due diligence and seek proper financial counsel before making an investment decision. Nothing presented today is investment advice. You are listening to the Maple Tree Capital podcast. I'm your host, Henry Invests on X, founder of Maple Tree Capital. Welcome to In the Treehouse, where I talk about some of the portfolio moves that I've been making over at Maple Tree Capital in our two portfolios, Heartwood and Jonah Gold. As a reminder, those two portfolios are a little bit different. So Heartwood is more centered around more mature companies who have some large moats and are maybe just a little bit misunderstood or cyclically out of favor in the business cycle. Jonah Gold, on the other hand, is really a lot of innovative tech, really hyper-growth companies that have experienced a sharp decline in their business that are sort of coming back and emerging near inflection points when the market continues to doubt them. So that's a little bit about the differences between Heartwood and Jonah Gold. Now, as for portfolio moves over the past week, I think it's important to take a step back and look at where the market has been. Really near all-time highs, right? At the same time, though, it does seem like pockets of the market are starting to roll over a little bit. You know, the close on Friday was very, very bearish, especially for fintech names and financials in general, as we got the news that JP Morgan might be charging for access to customer data. Now, that's not a big deal for Upstart or any of the companies that I personally own, but it is something that really did move the market. And the fact that it moved the market so severely, given the fact that really the weight of it was not that important for all fintechs across the board, starts to make me think that the market is looking for reasons to take profit. So I'm cautious. I talked about on last week's podcast a book I read called Best Loser Wins by Tom Hogarth, and it has totally changed my mindset as to how to approach trading. So I think, as investors, right, we sit there and we try and trade the market that we believe should be happening. But we have to trade the market in front of us. That's how you make the money. It sounds so obvious, but I really just had the epiphany click for me not that long ago. So what did I do last week? Well, I sold a lot of covered calls in Jonah Gold and made a decent amount of money, which I reinvested into shares of Upstart, several $100s. I think when people think about covered calls, like, okay, well, I have to ride this to expiration. That's not inherently true. And this is the part of Jonah Gold's strategy that I really, really love. Is when I start to build up big, large positions in misunderstood growth companies that are high beta and have high implied volatility, so the options chain is very liquid, well, there are several opportunities to sort of farm the premiums, if you will, on those equities. Now, of course, I'm not going to sell covered calls or anything into an earnings report or something like that because I'm very bullish on the long-term trajectory of them. But if the stock is rocketing, having some great days, and I'm looking at the chart here and I'm saying, okay, like a pullback is necessary, or the chart indicates that a pullback is coming. The longer that you're invested in these names, the more that you watch them, you start to understand their behavior. You start to understand how they trade, why they trade, how they trade. An example of that would be Upstart normally starts the day really strong and sort of fades into the end of the day. Well, why is that? Because shorts cover right at open. So things like that, you start to get a little bit of a knowledge advantage on maybe how security trades. At least that's my experience. So what I like to do is not be bearish. I know that's what covered calls tends to imply, but sort of just farm some of the theta decay. So that's what I did on Upstart this week. So I farmed theta decay. I made a really large amount of money on that and then bought more Upstart shares with the profits. So if that trade would have moved against me, as it says in the book, Best Loser Wins by Tom Hogarth, which I totally recommend, well, then I would have just covered for a small loss because I'm not looking to sell my shares. But it's a nice way to actively trade and ride the waves of the markets without really having to put up additional capital. You have to put up additional capital if you end up buying them back. But if you don't, it's a nice way to place a trade while really not doing all that much. And so I've come to like it, and it's a strategy that I know I've been talking about in my shareholder letters for a while, but I'm starting to like to use it and utilize it a lot more. And of course, in this market too, where it's a really heavy bull market, there's a lot of liquidity on the options chain, which makes it much easier. So I think the market is getting to a point where we may see a 3 to 5% dip. Tariffs on the EU and China, the EU and Canada, just announced a couple of days ago. Bitcoin doesn't seem fazed by that, but we'll have to see how tech stocks open up on the overnight markets. But yeah, there's reasonable reason to be cautious. So certainly not in leverage or anything like that. Call options, maybe a seller of calls on Monday. But we'll have to see. So that's something I'm monitoring. Going back to last week's podcast, I talked a lot about the moves that we were making in Jonah Gold. More so how a position that we had bought 2 weeks ago, I think it was in episode 1, or maybe 3 weeks ago, episode 1 of the Mapletree Capital podcast, Shark Ninja. We bought that at $90 a share. It is now over $110. So that's a large move. Too bad that it's a small position size. But hey, I'll take it. So that's about a move of 22% in a couple of weeks. And we told listeners, or I told listeners really, that it was a large story about the innovation mode. The rate at which they were innovating was their competitive edge, while at the same time they were insulated from tariffs a lot more than the broader market believed, because they had planned for this by diversifying their manufacturing during the first Trump administration. Very strategic. CEO is a rock star, does a lot of public-facing interviews and content. So I just very bullish on the brand. It's a very recognizable brand. It's durable. It's cost-effective. A lot of Gen Z likes it. I think it's a brand that's positioned honestly for greatness. So continue to remain bullish on that. Wish I would have had a little bit more exposure, upped my stake, but I didn't want to sell some of the other positions that I found very favorable. So Shark Ninja, continue to hold. I know he said that maybe look at trimming that. I'm just going to let that one run a little bit longer. I think the momentum on it is too strong, and starting to see a lot of sentiment pick up on it for FinX or online. We'll just put it that way. So that's a little bit about what I've been doing in the portfolios this week. Remaining cautious, treading the waters, and looking for opportunities when they arise. You're listening to the Macro Pulse. This is the Mapletree Capital podcast. It has been sort of a relatively quiet week for the macro, but certainly the news cycle has started to pick up a lot as well. Let's talk about it a little bit. So a little bit calmer, like I said, than it maybe has been in weeks past. On Monday, markets were at all-time highs, and the NASDAQ was really outperforming, but that sort of recoiled on Thursday when President Trump confirmed a 50% tariff on all copper imports effective August 1st. This caused copper futures to spike, and traders began repricing everything from sort of EVs to heavy wire building projects. At the Federal Reserve, the June minutes came out and revealed that an institution that's really strongly divided. Some officials think that tariffs will create persistent inflation pressures, and there are others who see need for an insurance cut as early as July, as they worry about employment sort of rolling over. Chair Powell has tried to project unity, but outside pressure has continued to intensify. Bill Pulte, not sure exactly how to say this, guy's sort of come out of nowhere, head of Fannie Mae and Freddie Mac's board, has publicly urged Powell to resign, and he's also really tweeted out a story that Powell is considering resigning. Now, there's no confirmation of this news other than from Pulte himself, so I take that with a grain of salt, but this is really a new level now in the political pressure that is being put on Jerome Powell. We've gone sort of from just calling on Powell to resign to maybe even making up fake stories that he's considering resigning. So while most analysts expect Powell to finish his term, the spectacle has reinforced the perception that the Fed is now caught in a three-way vise of sticky inflation, White House job-owning internal disagreement over the proper policy stance. It's starting to become very chaotic. And to me personally, right, I'm starting to feel like it's not only just disrespectful, but ridiculously disrespectful for the Trump administration to come in here and tell the Fed Chair Powell how he should be doing his job. Yes, I think the Fed is probably 100 basis points behind where they should be, but who is the result of that, right? President Trump and his tariffs, and Trump can levy the tariffs all he wants legally. So, that's his prerogative, but there are effects, or there are things that come with, actions like that. And I don't think it's unreasonable for the Fed to sit there and say, okay, like, we're really worried about tariff inflation. We're going to need more data before we cut. But to sort of steamroll the market with tariffs and then to blame Powell for the volatility that's created and for the policy stance that's created, and then call for his resignation, to start trashing his reputation, to sort of no longer call him an American hero and really just defame him, I think is very poor class from the Trump administration. And we'll talk a little bit more about the Trump administration's sort of waning confidence in their supporter base. So initial jobless claims also slipped to a 7-week low of 227,000 last week, hinting that the labor market remains too tight for the Dove's comfort, even as ISM services softened and private payrolls cooled. Treasury yields flattened. 10-year notes dipped briefly below 4.35%, but they later popped back up on tariff news. So equities oscillated. High multiple tech and crypto shrugged off the policy change, or policy angst, and Bitcoin pushed through 117K over the weekend, whereas traditional cyclicals and small caps bore the brunt of the copper shock and sort of the delayed rate cut odds for the Fed in July. So now we're getting into something that's really interesting, and it's really not too related to the markets, but it's definitely related to the Trump administration, which therefore is related to the markets. So there's a new catalyst going on behind the scenes, and I think once I say it, maybe people will laugh at it, but I think it's certainly something to keep an eye on. So the Epstein files, they've sort of been pushed under the rug by the Trump administration. Trump put out a long truth social post last night talking about how the Epstein files needed to go away and that nobody really cared about them. And he actually got ratioed on his own platform, which was unbelievable. So I'm going to go ahead and read that post to you all now. Quote, "What's going on with my boys, and in some cases gals? They're all going after Attorney General Pam Bondi, who's doing a fantastic job. We're on one team, MAGA, and I don't like what's happening. We have a perfect administration, the talk of the world, and selfish people are trying to hurt it all over a guy who never dies, Jeffrey Epstein. For years, it's Epstein over and over again. Why are we giving publicity to files written by Obama, crooked Hillary, Comey, Brennan, and the losers and criminals of the Biden administration who con the world with Russia hoax, 51 intelligence agents, and the laptop from hell, and more? They created the Epstein files just like they created the fake Hillary Clinton/Christopher Steele dossier that they used on me, and now my so-called friends are playing right into their hands. Why didn't these radical left lunatics release the Epstein files? If there was anything in there that could have hurt the MAGA movement, why didn't they use it? They haven't even given up on the JFK or MLK Jr. files. No matter how much success we have had, securing our border, deporting criminals, fixing the economy, energy dominance, a safer world where Iran will not have nuclear weapons, it is never enough for some people. We are about to achieve more in 6 months than any other administration has achieved in over 100 years, and we have much more to do so. We are saving our country and making America great again, which will continue to be our complete priority. The left is imploding. Kash Patel and the FBI must be focused on investigating voter fraud, political corruption, Act Blue, the rigged and stolen election of 2020, and arresting thugs and criminals instead of spending month over month looking at nothing but the same old radical left-inspired documents of Jeffrey Epstein. Let Pam Bondi do her job. She's great. The 2020 election was rigged and stolen, and they try to do the same thing in 2024. That's what she's looking into as AG and much more. 1 year ago, our country was dead. Now it's the hottest country anywhere in the world. Let's keep it that way and not waste time and energy on Jeffrey Epstein, somebody that nobody cares about. Thank you for your attention to this matter." End quote. So sort of a long, rambling post forcing in all of these achievements, according to Trump, that have been witnessed over the past 6 months while downplaying the significance of the Epstein story. But I think that the Epstein story is a much bigger story than what Trump is letting on, and he knows that too. We were promised the files. Pam Bondi said that she had them in her possession. They then released clips from the jail where there's a minute missing, right? And Trump himself is going way over the deep end here to basically say that the files are not important. He's like, why didn't Biden release them? Well, Trump, you have the power to release them as well. And then it just ties back to Elon, who said during their big feud with Trump like 2-3 weeks ago, the real bombshell is that Trump is in the Epstein files. So something to monitor. You don't want to get too deep into the conspiracy narrative, but I think political pressure on the Trump administration is growing, and I think some of that anger may be falsely being directed at Powell. But if I don't think the Epstein file story is going to go away. I think the administration is soon going to realize that. And so just something to keep in mind, that it does seem like the political administration in power, the Trump administration, is under some political pressure. So definitely just keep it in the back of your mind when you're trading, especially as the market is at all-time highs. So that is it for today for the Macro Pulse. It's time for Stock of the Week. This week, we're going to be talking about a video game developer that's share price really has been range-bound for the past couple of years. They make popular games such as FIFA, or FC now, Madden, and The Sims. That's right, you guessed it. It is EA, Electronic Arts. So this is a $37 billion company trading at 35 times trailing 12 months earnings with a forward PE of about 40. Sounds very expensive, right? Well, the thing with EA, and this is why I've owned it for Maple Tree Capital in the Heartwood portfolio for a while now, is that PE actually looks a lot larger than it really is. And the reason for that is because of the research and development, or the R&D expense. So since EA is such a CapEx heavy, business, in that they continually reinvest a lot of their earnings in developing new games to fuel future revenue growth, the PE looks a lot larger than it actually would be if, say they halted research and development. So it's much more profitable business than I think people realize. So for example, in 2025, in 2024, they did 1.3 billion in net income on 7.6 billion in sales. So that's a 17% profit margin. That's really, really good. Okay, so this is a very highly profitable business. Now, something else I want to talk about before we get into the things that have been bogging on the stock is this live services revenue. So you can think of this as microtransactions. So a purchase within a video game. I'm not sure everybody's going to understand that. So say like you're buying a skin in Fortnite or something like that, right? Or you're buying coins, virtual in-game currency, or Robux or V-Bucks or something like that. That would be a microtransaction. You're making a purchase inside of a game. EA calls that live services revenue. Now that, as a percentage of overall revenue for EA, has grown from about 10% in 2016 to north of 50% in 2024. So they're monetizing inside of their games very, very well, which is important because it creates sort of an emotional connection between the player and the brand or the video game if they're willing to spend additional money inside of the game. So that's something I think is very compelling for EA, is that their monetization is getting better. Now, the criticism on that is, well, yeah, but they're monetizing the games to death, which is hurting the brand image. I also think that's true. And I think the perception of the company is a net negative, and people do think that they're just a greedy, money-hungry corporation. So a large part of the thesis here, too, is, look, the IP with Madden itself is so valuable. And I think that the company's talent and skill set and history is also too valuable to sort of let die, if you will. So I expect an activist investor will come along in EA, get an influential seat on management, and sort of steer the company in the correct direction as to how they should be marketing their games, how they should be interacting with their customers. But even if that doesn't happen, you're looking at a very highly profitable business right now that's sort of been range bound for a couple of years. AI tailwinds, right? AI will allow for better games to be developed. When it comes to research and development, EA has spent more money on research and development from 2016 to 2022 combined than EA has spent more on research and development than Activision and Take-Two Entertainment, the maker of GTA 6, combined over that time period. So they're investing a lot in their games, and so I think that their AI advantage is probably pretty pronounced. It's just, how do we deliver that? How do we monetize that effectively without really pissing off, if you will, a lot of our customers? So that's something that EA has to get better at, and I think an activist investor could get involved. If that were to happen, we're talking a huge, massive video game maker, a massive video game company in a space that's been surprisingly sticky post-COVID. Currently $37 billion today. I think there's a lot of upside potential. There's a lot of execution risk to get there. But it's a stock that, I think should be on everybody's radar. It gets a bad rep, right? Like, let's be real. If EA had a better reputation across the broad industry, their valuation and their stock price would likely be a lot higher. So it's trading here for a reason. Maybe that's a pretty well-founded reason, but, as an analyst, our job is to look into the future and see where these brands are going. I think the performance of the stock and just the perception on the brand is almost undeniable. That top management has to be aware of it. And I also think that would result other independent operators or somebody who may be interested in the stock to understand that as well. So I think you could see some sort of activist investor come over and take over a seat on the board, which I really think would drive the share price a lot higher. So that's a huge catalyst that I think I'm sitting on. But other than that, the thesis is really the same. Very, very pronounced titles such as FC and Madden and The Sims, which are not going away. They're sort of taking the Nintendo approach and making a Sims live-action movie, which should also have a lot of upside and bring more popularity to the brand. And I think just in general, AI, I'm super bullish on, and in 5 to 6 years, what is AI going to look like in video games? That's probably going to create a more immersive experience. Younger generations are spending more time online, right? So it's just a matter of if EA can figure out how to, have microtransactions, but make it so it's not too obscene and really fix that connection that they have with their users. It's something that I'm surprised they've chosen not to do. A little bit money hungry, certainly, but like I said, I think an activist can come in and fix that. So if you look at the stock today, as I said earlier, it's trading about $37 billion, $148 a share. This is roughly the same price that it was trading almost 2 years ago. The stock has been a big underperformer of the general market over time. So I think, once again, depending on what happens with management, there's a lot of room to the upside here. Unfortunately for me, I bought the stock in November of last year, which was around $160 a share, and then they announced preliminary guidance, which was terrible, which sent shares down to $130. Now, that was a very cheap valuation. I ended up not picking any up just because I was at maximum exposure, initiated with a large position. But the shares have rebounded pretty substantially to $149 a share, and they were almost up to $160 just a couple of weeks ago. So one to watch, and it's not necessarily like a super confident thesis. To be honest, you might be able to make the money on it if you buy after the after the activist investor news comes, if it does. But I just think it's one that I wanted to highlight and put on people's radar today. Lots of R&D spending. I think they'll do well for an AI advantage as long as they can fix that connection with their users. So EA, Electronic Arts, is this week's Stock of the Week. We're closing out this week's episode and every episode with the retail mailbox, where we answer questions submitted by listeners. This week's question comes from Megan, who says, since you take pride in being a bull, what's a stock you will always be bearish on? It's a great question, and it's true. I do take pride in being a bull. I would say that I'm not a perma-bull, but definitely view the markets as more opportunistic to the upside relative to the downside. So, as such, I tend to be in a lot of very young, innovative tech companies, which some would call very unpractical, but I think it's actually very compelling. So really the businesses that I'm bearish on, apart from, like the automakers, and not calling Tesla an automaker, but like Ford, GM, very low margin, high capital intensive businesses. I think airlines too, right? Although Delta had very surprising results last week, and that brand seems to be doing very, very well. But, apart from sort of the more common ones, I think for me, it's got to be legacy businesses that are trading at high valuations. You would think maybe insurance companies would be in there, but insurance companies actually trade at low valuations. So I think people know where I'm going with this, but the company that I will always be bearish on, just from my worldview, my frame of mind, the research I've done on a company called Upstart, leads me to be bearish on FICO, Fair Isaac Corporation. This is an IP licensing business, meaning that they license out their technology and their FICO score for fees, and it's sort of a monopoly on the credit quality and the credit standards of all of America. Now, they have been facing, it trades at a ridiculous valuation, something like 40 to 50 times earnings. They're facing a lot of regulatory threats. Pulte, who we talked a little bit about earlier in today's episode, is sort of coming after FICO very, very hard, now saying that for mortgages, people can use the Vantage score, which is an alternative to FICO, and they're starting to face a lot of regulatory pressure. And why is that? Well, because the FICO score has been around for decades, but during that time, they've actually innovated very, very little. And actually, really, they've just raised their price. So when you combine a lot of price hikes, which are accepted by the general market because there's no widespread competition, and you couple that with sort of innovation that's been lacking, you get this perception of a business that is unstoppable, unbeatable, that is a monopoly, and it starts to trade at a very high valuation. But really, what's happening with FICO is there are so many companies right now that are sort of popping up in how to better do credit, right? You can think of Firm, you can think Upstart, you can think, I maybe even put SoFi in there, Lending Club, right? Different ways to lend, different ways to think about, credit worthiness and the things of that nature, and it's putting a lot of pressure on FICO's business. And I think as time goes on, that pressure is only going to mount. Why? Because the AI advantage of a company like Upstart is also going to compound. So if FICO wanted to start now to sort of rehash or rethink how they're going to do their business model and their scoring moving forward. Well, it's an uphill battle against some companies that have already started to go on that path over 10 years ago. And so I think that's probably the realization that they're having internally. People will say, oh, it's a compound or it trades at a high valuation, like buy the dip on it. And, we'll see how it works out. But I think legacy companies like FICO that have had a market-leading position for decades with very little innovation, very widely hated by the general public, and are now facing regulatory pressure. I mean, I've been bearish on FICO internally. I mean, meaning I haven't acted on it, but I've been bearish on FICO for about 2 to 3 years now. Now, the stock did absolutely skyrocket over that time frame, so I'm happy that I was very internally bearish versus externally. It's very hard to time those things, but over the past couple of months, really, I guess back sort of towards December, so a little less than a year, shares are down 35% from their high, and it's still trading at a 67 times earnings multiple for a company that doesn't really have a large trajectory of growth in front of them. If anything, they're going to be facing a lot of headwinds. So I think the stock's experiencing a re-rating to the downside. I mean, this is a stock that's over $1,500 a share, and in 2021 was $400 a share. Right, so that's well over a threefold, almost a fourfold to the upside. During that same time, the competition has sort of narrowed the gap on being able to predict credit worthiness. So I'm very bearish on FICO. I think the business itself is inherently flawed. As Upstart CEO Dave Gerard says, IP businesses or IP licensing businesses are great until they aren't. And I think we're starting to get to the point where, FICO's business is going to be under a lot of pressure. So I'm bearish on FICO for those reasons, as well as just my internal worldview that AI can better price credit. But thank you for the question. And if you'd like to submit a question to the retail mailbox, make sure to DM me on X at HenryInvest or leave a comment here on YouTube and Spotify.